As earnings season begins to wrap up, we've got no shortage of drama that is keeping the market stuck in neutral, at least for now. What does it mean and why? Well, that just means it's time for yet another cocktail investing podcast. Welcome back, new listeners, old listeners as well. This is the Cocktail Investing Podcast, where we look to distill everyday noise into clear investing signals. And I have to say, it is good to be back. Kind of like a line from Tony Stark in Iron Man 2, if you will. Why do I say that? Because we've got earnings, we've got economic data, we've got trade talk with China and Iran, and of course, speaking of Tony Stark, the Avengers Infinity War has taken the box office by storm. Once again proving that our investing theme known as Content is King is indeed king at the box office. I'm Chris Versace, Tematica Research's Chief Investment Officer, and joining me from wherever she is, I don't even know anymore, folks, is Lenore Hawkins, Tematica's Chief Macro Strategist. Right, Lenore? I mean, where are you today?
Yeah, I'm back in Italy today, but was in France for quite a few days.
But then Ireland, and I mean, it's like
back over to Ireland tomorrow.
I think my GPS chip would, if I had to plant like one of those things that people use to keep tabs on their dogs, I think it'd be crazy. It'd be like bing, 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 bing. Unbelievable.
I log way too many frequent flyer miles.
I bet you have. So we've got, a little bit to catch up on and talk about. We're right in the midst of earnings season, and I know, you've got some things you want to talk about on the economy and the markets. But first, let me do that one piece of stuff that I have to do all the time that I have to do it. So that's the housekeeping stuff, which is please check out tematicaresearch.com. That's where you can find all of our wares, as we like to say, everything from the weekly wrap that Lenore puts out, which is great. It also now previews what you can expect from the week ahead. You can take a look at the thematic signals. These are the signposts that we watch for our investment themes. Some recent example talks about the coming of $3 gas, about how Chico's FAS is partnering with Amazon, kind of yet another Lenore. If you can't beat them, join them. And then some other comments about Warren Buffett, whether it's on increasing demands for cybersecurity or how disruptive technologies will impact the insurance industry, all that and more. We've got past podcasts over at tematicaresearch.com, as well as our premium products. So go on, take a look. And if you got some constructive feedback, click one of those links there and let us know. So with that out of the way, Lenore, we are getting ready to exit the first quarter earnings season for the most part. Yeah. We haven't heard from retailers or, that whole group with those funny fiscals at the end of January. But any observations on first quarter earnings? Because I say that I'm asking this question because we both know that expectations were high, 18 to 19% earnings growth with pretty much the same for the balance of 2018. So as I think it was John McLaughlin, maybe Stuart Varney, what say you?
Well, it definitely was a different earnings season with respect to the response from the market that we've seen in the past, right? This was very much what have you done for me lately? It definitely looked like an awful lot of that phenomenal earnings season was the results were actually already priced in.
Yeah.
And really, if you kind of strip out these non-recurring things, earnings season isn't quite as stellar as it actually looks on the surface, right? Because the benefit from tax reform, that isn't something that's going to burst earnings on a year-over-year basis every year, right? That's not
it's really a one-time adjustment to the outlook because in 2019 you get the same benefit. There's no more drop down in the tax rate, and I know exactly what you're talking about. I was listening to Disney's call last night. I'm very excited. Bob Iger's talking about all the new lands that they'll be opening in Disney World. He talked a little bit about the roadmap for the Marvel films. Very cool stuff. But when you look at their results, the bottom line EPS number beat by like 23%. And you sit there and you go, wow, that's pretty good. And then you realize that they repurchased like year over year, like 30 million shares or 5%. Right.
Exactly.
Then to your point, you take a look at the tax rate. Well, year ago tax rate for March 2017 quarter over 30%. This year, 20%. So you start digging through this,
and let's not forget that the dollar had been plummeting.
And that is a great point, since Disney is an international company with operations like in China, Tokyo, France, where you were, and some other things. So it's a great point. And as I'm sure we'll talk to, the dollar looks like it's reversing, which tailwind could become a modest headwind. But the point here is Disney's operating income rose 6% year over year, which is great, but not as great as the bottom line EPS comparisons would have you believe.
It's completely true. Yeah, the bottom line EPS it's very difficult to pull something meaningful out of it. Looking at the S&P 500, if we pull out the effect of tax reform, share buybacks, and the strong dollar, it leaves earnings up only about 10% a year.
Now, are you saying that for the S&P 500 as a group?
Yes.
Okay, so what you're saying then is people who are thinking, wow, 18% EPS growth, a slap on a PE multiple of 16, 17 times, whatever it is, not really all that exuberant on the bottom line.
Exactly.
Okay. Well, any other comments coming out of earnings season for you? And I'm asking that because I do have one I want to talk about for tax reform, but I want to see a little more of what you have to say. See if you can bamboozle me, as it were.
Bamboozle you. Well, I think a few of the ones that were most interesting to me, I have to say Tesla is looking to me like another indicator of a toppy market.
We're not going to have any boring questions or anything like that.
Exactly. That really tells you something about the state of the market when a CEO is very comfortable mocking analysts because they're asking such mundane things as far as cash flow. Who the hell cares about that?
Well,
right? Companies don't need to actually generate cash because we live in a world where cash flow is boring.
Well, on the one hand, I think part of it is that Musk might be playing a totally different game, right?
Yeah, well, he definitely does play a different kind of game.
Yeah, which is understandable, right? I mean, and you understand that in order to be CEO of not one but two, and I think at 1.3 companies, you've got to have a very strong ego. I think we understand that. But the thing that got me was how he turned to a YouTuber for questions.
Yeah.
I mean, it's funny. And I was talking with some people that I know in investor relations about this just to get their assessment. And I think the universal comment was he should be done, meaning no longer doing these conference calls, but his ego won't let him.
Well, and Tesla really is, an awful lot of Tesla is about the cult of his personality.
Yes.
So it's tough how do you have Tesla without that personality leading the charge?
You mean like Apple without Steve Jobs?
Yeah. Although but I will say Apple, here's an idea, makes positive cash flow. Kind of important. And one of the things that didn't get talked about at all, which kind of cracks me up with this, this incredible, and the potential with a Tesla type company, obviously profound, but there's some very real problems. The production line, right? This car was not engineered for an efficient production line, and they're running up against some very serious problems with getting more cars made. And that's like how they're going to solve that problem is anything but obvious. So that's great. You've got this company that has a big demand for its products. It doesn't seem to be able to really ramp up production. So where are we going to go with that? And we're having some serious problems with quality.
So let me just ask you this, because I have my own view, and which is Tesla, I think, is enjoying a moment in the sun. And I think from our thematic perspective, it is affordable luxury, kind of living the life, some product that indicates affluence.
And disruptive technology.
And disruptive technology.
It's something very, very different. I mean, if you've ever been inside of a Tesla, it is, because I was not just, I'll admit that from an aesthetics perspective, I do not find the Teslas particularly attractive when you look at the body design. They're not to my taste. So I was not predisposed to like them. And when I got into one for the first time, I was like, holy cow.
Very different.
This isn't a car. Like this is, if you want to call like a really nice car, you want to call a high end like BMW or Mercedes a car, you can't call Tesla a car. It's just such a different thing. It's like an iPad with wheels.
Correct. Well, that whole control display is phenomenal.
It's an incredible machine, but as a disruptive technology, is this thing actually viable as a company? Can they get that production line going? Can they actually ever make money? And can they do it in time before the other guys catch up? Because there's a lot of progress being made.
That was exactly my point, which is they have an early mover advantage, right? But we know that Ford, Volvo, Audi, everybody else is coming down this path, particularly since we're going to see the combination of electric vehicles and autonomous vehicles kind of converge. And I think that makes a very interesting and different landscape, not 2019, but 2020, 2021.
Yeah. And when you look at these major disruptions in technology, it often does not pay to be the first mover. It often doesn't pay to be the one that's there out on the cutting edge, because you're out there making all the mistakes and everybody else can just watch you and go, all right, well, I'm going to see what you're doing and I'm going to make marginal improvements and I'm going to avoid the mistakes, the costly mistakes. So the shareholders of that first mover often pay for the benefits received by the shareholders of the guys who came in second, third. And case in point, what you were saying with Apple is infamous for not being a first mover. No. They're just the ones that implement it better than anyone else, but they're way behind.
Yeah. Oh, I was just going to say, you took a page or you described a page from the Apple playbook without a doubt.
Yeah.
So, okay. Speaking of Apple, any surprises for their earnings? People have asked me, I did a big hit on Cheddar with it. My take on it is, good. Not great, better than was expected, right? And
interesting though, and the comment by Caterpillar CFO.
Which one would that be?
That we may be seeing the peak.
Oh yeah, where they're talking about their peak and their margins.
I didn't expect to have a CEO kind of say that, and then investor relations tried to walk it back. Of course. He didn't mean that. Just kidding.
Well, but it's interesting because I think that just to go into the mini Wayback Machine, we left 2017. People kind of bullish on the economy, right? Oh, tax reform is going to be great. Expectations for tax reform and spending. And we've seen confirmation of the positive impact of tax reform, as we were talking earlier with Disney and others, on the EPS line. We're seeing it on the buyback front. We saw that with Apple, where they supersized their buyback program by some ungodly amount and boosted their dividend. So we're seeing that positive impact as well. But what I don't think people expected was to come in and hear costs are rising.
Yeah, that's
because people were so focused on that revenue line and the bottom line, they didn't really think about the innards of the P&L. And to your point, when Caterpillar comes out and says that, and they cite rising steel prices and commodity prices, that is going to get noticed. And I think it was in today's PPI report, if I remember correctly, for April, that steel, I think, ticked up something like 3%, year over year. So we're starting to see that kind of follow through a little bit.
And it doesn't look like that's going to be changing directions, at least from a political standpoint, given that we seem to be moving a bit more and more into these tariffs. With President Trump's decision on Iran. That's not really going to that doesn't help lower costs at all.
So before we were taping, you had mentioned that you were in a meeting. And you were, as the news broke, you were surrounded at the table by, was it 4 or 5 different countries or something like that?
Yeah. It's the challenge here is that he kind of unilaterally changed the playing field. So you have all these companies, American companies, who have been working with European companies who work with potentially, because Iran, by the way, if you're in Italy, like Iran's like right there. So, I mean, it's not, it's funny when I moved over here, I just had such a different perspective because when you live in the States, you think of the Middle East as like kind of way over there. And when you're here, it's like right there.
Yeah. It's funny. There was one time when I had to go to Dubai and I was coming from the States, and the sales guy who was doing it, the institutional sales guy was based in London, but he grew up in Italy. And when I was saying something about it, he goes, "Please, right across the right across the sea for me is Africa. It's no big deal."
Yeah, exactly. It's kind of right there. So now you've got, and no one really knows. This is, I think, the what actually happened last night with Trump's decision is much more impactful, not specifically exactly about Iran, but what this means for the U.S. going forward and for companies. And good God, like everything's a multinational.
But do you think,
and
we're kind of segueing a little, which is fine because this is important. But do you think that Trump is doing kind of what he did earlier in the year? You know what I mean? When he started talking about trade and tariffs and stuff, where he's negotiating and he's trying to keep people off balance.
I realize that, and he's being successful with that. And
Yeah.
But that is the problem. The problem is that this was an agreement amongst a whole hell of a lot of countries that took 20 months to put together. And he single-handedly comes out and says, okay, the U.S. out, but no details. So now no one knows what to do. So you've got companies like U.S. companies that are doing work with European companies. And those European companies may be interacting directly, indirectly with Iranian companies. Now that can no longer happen. Maybe. We're not really sure. No one really knows what exactly is going to happen because this announcement was made without any details. Right. And the thing is, what I'm looking at from this isn't the first time that this has happened.
No.
This seems to be the pattern.
Correct.
So the pattern is we have a president who comes out and makes an announcement that really kind of pulls the rug out from underneath parts of the global economy and the way people interact with each other, but has no details to follow it. So everybody's just looking at each other going, oh, crap, this is probably bad, but we're not exactly sure how bad or what this means. Nobody really needs to know. So then what happens? Everybody slows down. And that is just one more headwind to the economy because everybody kind of takes a step back and goes, okay, so instability and risks have just gone way up and we have really no idea kind of where the parameters are all on all of this, right? Because it is that, what he's doing, I understand, could be very effective as the CEO of a company, could be very effective as an individual. It's very challenging to be doing these unilateral things that have such big ramifications for the rest of the world, throwing it out there, and then there's no details. There's no backup.
Totally agree. A successful strategy for the CEO of a private company.
Exactly, yes.
Private company where, very limited shareholders, very different than something that a public CEO could get away with, even more so, very different from what you would think a president could, should do.
And I would, I could even go so far. I don't know this is the case, but let's say, for argument's sake, with respect specifically to the Iranian situation, perhaps he's able to get negotiate something that he thinks is better. Perhaps he's totally successful at that. But there are costs. And these
absolutely.
costs are not direct. They're not obvious, right? So these costs are costs on the global economy, and they're costs that affect American businesses because American businesses now working with American businesses becomes more complicated. And America, that's like the capital. Capitalizing money.
Is it fair to say that maybe he's focused on the win, as he defines it, but not at the hidden costs of right, exactly. Now it makes it difficult for American capital to be deployed, which is not something he wants. You would think.
No, right? You would.
Yeah.
So it just things keep getting more and more complicated. It's bottom line on that.
So I think just to sum up the environment, 2017 versus the one we're in. 2017 was all good for the market, right?
Yeah, everything happening was going in the right direction.
That's exactly right. And we had some push outs. Healthcare reform didn't work, obviously. Infrastructure still, out there lingering along. But tax reform got done, and people expected yet another good year. And what they've been facing is a lot more of uncertainty as I think Trump really starts to go, quote unquote, go to work.
Yeah, exactly. And that uncertainty, by definition, means more volatility and higher costs. Because because when you're uncertain about things, when a company is uncertain about its future,
you do nothing.
Its cost structure gets more challenging, right? Because you maybe you have to deal with some things, but you're not really sure what your parameters are. So by definition, it just gets more expensive, more complicated, more time consuming. Productivity goes down.
Yeah.
Right. Because
think of
that's not something we want to see.
Think of a company that is juggling several balls, right? Whether they're operating their business, they're having new products coming out, they're looking to make an acquisition or maybe a divestiture. There's a lot of things that preoccupy their time on the sidelines that can take away from running the business.
Yep.
And that's what we're talking about. So, all right, let me just circle back a little bit because I do want to get one final thought in on tax reform, as well as these rising costs we were talking about. It wasn't just Caterpillar. There are other companies out there. We're seeing continued increases in lumber prices, something you talked about, a couple of months ago, again, as a result of trade negotiations. Restaurant companies, are talking about higher wages, particularly in California, which, as we can expect, we're going to see that impact, I think, ripple through the cost structure. With that in mind, real quick, what did you think of the April employment report on the wage line?
I think so there's two ways to look at it. Like right now, to kind of answer that question too, are looking at the JOLTS report, right? Well, that JOLTS report had the highest.
That's crazy how high that number was.
Exactly. It was incredibly high. It was like 6.55 million job openings versus expectations for 6.1. So the difference between expectations and reality.
Well, but the hires was the higher. I keep trying to remember. It was like 5, but it was like 5.5, right?
But it dropped.
Right.
Hires, a key is while we're seeing job openings growing and growing, the new hires is actually slowing, and it's slowing more and more. And that actually makes sense when you look at what businesses are reporting is like their number one pain is the lack of quality labor. So what I think when you're asking about the wages, one of the things I think is going to be very, very challenging is here we are this month, happy anniversary, marks the 107th month of this expansion.
Yay.
And it is now the second longest expansion on record. Going back to World War II, the mean for an expansion is around 60 months, and here we're at 107.
You're making me nervous, Lenore. I just think I'm thinking we're due.
Well, we've never before in history had the government use such dramatic fiscal stimulus at this stage in the cycle. We've never before seen taking on massive deficits when the unemployment rate is below 4%, when job openings are at record highs, and where the number one problem that companies keep reporting is the quality of labor.
Oh, I understand all that, but and I hear what you're saying, but in the back of my mind, I'm thinking about this. Just circling back to tax reform, and hopefully I'll tie this together with a little bow on it. When companies reported the December quarter, they were saying, we need more time to study the impact of tax reform. So people were expecting to hear more as companies reported March quarter earnings. And we've gotten some visibility, some clarity. We talked about it earlier with Apple, in particular, Disney with their lower tax rates boosting the bottom line. But what we haven't seen is businesses really opening up the wallets and cranking up the spending. And part of what I'm thinking.
Nor have we seen households do that.
No, you're absolutely right. And what I'm wondering is, were expectations a little aggressive for that just to happen, right?
I think
immediately.
Well, we talked about that in that I found it sort of mind-boggling to think that we were going to see this massive explosion in
all of a
CapEx,
sudden, right? Like
CapEx
the next day.
And to say that CapEx spending was going to explode because of tax cuts. Like, well, wait a minute. Look at the cash balance on corporate balance sheets.
Yeah. Well,
they already were sitting.
Isn't corporate debt at a new record level?
Oh, corporate debt. Yeah, that's another one. Corporate debt's got me very nervous. That actually kind of keeps me up,
okay.
Right?
But so what I'm thinking here, because we keep getting, it's all good stuff. But what I'm thinking is these expectations for business spending were a little aggressive. And what I'm wondering is, are we likely to see business spending, maybe consumer spending too, pick up, a little more in the back half of the year, maybe a little more in 2019. Maybe it gives us a little extra cushion or runway, sorry, that's a better word, for 107 months, 110 months, 112 months for the expansion.
I would be surprised. I mean, it's possible, but I'm not putting that as something I think highly likely, just given companies had a lot of cash. Mm-hmm. So it wasn't like they didn't have the money for the CapEx.
Well, there's that. And there's also the fact that as we talk about and we see every month in the industrial production report, capacity utilization is not exactly killing it. So what's the incentive?
No, exactly. I mean, they're already having problems. Or the productivity's not been phenomenal.
No, it's been the last 2 quarters have been like the weakest in the last 18 months.
And if you've got companies really complaining about the problems with quality employees, we're not seeing spending go up because there's a lot of debt out there. And I think these companies also are going to be nervous about looking at their corporate debt, right? We've got a record level of corporate debt out there, and a huge amount of it is coming due in the next couple of years. And let's not forget, all of that debt right now is at these record low yields.
Exactly.
And we've been seeing, interest rates ticking up and up and up and up. We've got like almost $400 billion coming due this year, over $550 billion coming up next year, nearly $1 trillion in 2020, and well over $1 trillion in 2021. I mean, that's and all that's going to come due. It's got to be rolled over, and it's going to be rolled over at higher interest rates. Right, so that's going to hit. If you're looking at that right now, you're going, okay, well, what do we have to expect for earnings? I'm like, well, I'm not going to ignore the fact that interest
what was those last 2 years you cited? 2021.
20, yeah.
And I'm jogging my memory. When does tax reform go away?
Yeah.
Interesting.
Talk about it. Yeah, double whammy, huh?
Could be. All right. Well, we'll obviously continue to watch the data and see if there is some lag effect with, tax reform and see what it means. But I'll
point out that along with that, we haven't seen the consumer spending. While credit cards, you and I have talked about on the podcast quite a few times about the rising default rates on credit cards, particularly those issued by the smaller banks, right, where that have people with kind of a little bit more wobbly credit. Well, right now, credit card standards have jumped up to where we now have the tightest standard since the fourth quarter of 2009. That tells me that we're not likely to see a credit-fueled consumer spending boom anytime soon.
Oh, I don't think so. If anything, we talked about this January, February. My concern that, and you just alluded to, we haven't seen the consumer pick up in terms of spending, that perhaps the consumer is doing what they did back in 2009, which is dig themselves out of that credit hole.
Yeah, we've seen the savings rate go up rather than spending.
Correct. Well, we'll have to see.
And that spending rate, that savings rate still pretty low.
It's horrible. It's horrible.
Yeah.
It's
so
horrible.
It's not like, oh, there's so much savings going on.
And just remember too that not to seem like we're all over the place, but just wanted to connect this in. I think we posted a thematic signal last week that talked about the median retirement count in the U.S. had $1,100. Good
thing we don't have a huge portion of the population retiring.
Yeah. Boomer economy. All right. Well, so we have a lot to keep looking at in the weeks and months ahead as we get more data. We've got another Fed meeting coming up in June, which is kind of around the corner. Any thoughts, Lenore, on 3 or 4? Is the data getting you hot and heavy for 4 rate hikes, or are you still thinking 3?
I'm feeling 4 is more likely.
And is there something that's tipping you that way?
Wages.
Okay.
Yeah, because that's one of the things the Fed really looks at. And I mean, we're really seeing some pressure there. Although we did see this morning, we had, what was it this morning? We had...
Hey, language.
Oh, crud. We had the producer price index rose less than expected this morning.
But year over year, though.
Blanked on it for a second.
Right. But year over year is still up over 2%.
Yeah, exactly. That's running hot. I mean, we're starting to see more and more things that are running hot now. I mean, personally, bigger picture, I do not think we're in a where we're going to see inflation really ticking off on a longer term. But I think that we're going to, within this cycle, we're seeing pricing pressure.
And unlike this time last year, which you noted, there is no issue of extremely easy comparisons, right? Because in 20, let me get.
We had the
2016, there was a lot of deflation. So it looked like 2017 last year, inflation for a very brief period of time was running hot, but it really wasn't.
Yeah, and then it rolled back over and that was just because you had crazy low in 2016. But this year, no, we don't have any of that. So,
well, I agree with you. I think it's more likely to be 4 than 3. Whether it's comments coming from companies this earnings season, PPI like we just talked about. If we dig into the ISM reports, we're seeing the price paid go higher. If you look at the market economics PMI reports, we're seeing the same thing.
Across the board, you're seeing prices.
Totally agree. And the problem, I think, is I think the market is still thinking 3, which means even though if we get 4 in the grand scheme of things, it's not a big deal. I think that there will be a period of like, what? I can't believe this is happening. And there will be a little mini freak out.
Yeah, I think, none of this stuff ever happens like smoothly and gradually. What I think at some point we will see a bit of a market freak out with what's going on with yields. So here we've got yields right now are around the highest they've been in over 10 years. And yet yesterday we had a very sloppy 3-year note auction. So that was for the 3-year bond. The bid to cover ratio was nowhere near what it's normally been. So there wasn't as much interest, and the street was left with about 42% of the issue. Now that's really big.
Now, back up, because even I'm lost in that.
So it didn't get sold off. So when the Fed issues new bonds, like they don't, call up Chris and say, "Hey, Chris, you want some bonds?"
Yeah, they do. They do.
The banks buy them, and then banks sell them. Well, the banks were left with a lot more than they expected to get left with, which is weird because you're saying, well, wait a minute. Now, I've bond yields are finally interesting relative to dividend yields.
Mm-hmm. And I think that's why we've seen some dividend yield
and
stocks.
Yet we're not.
I think that's why we've seen some dividend yield stocks kind of higher dividend yielding stocks kind of come under some pressure. Whoops, apologies for that, folks. But dealing with those international lines and web traffic, sometimes we get a little problematic. We get some problems that crop up here. So we lost Lenore for a second, but she is now back. And Lenore, you were talking about the sloppy 3-year Treasury note.
Yeah, that we had. So there just wasn't as much demand as you would expect, given that you've got the highest yields we've seen in 10 years. You're looking at that saying, wow, there's not as many people getting excited about these bonds as you would think they should, given how much better the yields are right now. That is one of those things that can just kind of overnight, you have a big problem. And that's what we've seen in the past. And you add that into what's happening with the dollar, because those two things are tied together. Mm-hmm. What the Fed is doing is strengthening the dollar. So the dollar's getting more expensive for all these international currencies, right? So you have a lot of pressure in emerging markets where they've borrowed in dollars. Their currency is getting weaker and weaker against the dollar. They're having to roll debt over. Interest rates are higher. Currency is higher. That all put together makes when they have to roll over this debt a lot more expensive. And we're seeing that in quite a few places.
Did you do all that in your head, or is there like some big whiteboard with arrows that you're looking at?
Sadly enough, that's in the head. There's an unbelievable series of whiteboards that just float around in my head.
I guess so. I hate to think how many colored dry erase markers you got going. So we've got that going on. But I also know, too, that for the technicians out there, they're getting a little concerned about the market because I guess over the last couple months, it's flirted with its 200 moving day average. And I believe the technical term is lower highs, which is what we're seeing. Definitely
lower highs, and that the trend has been moving decidedly in the wrong direction. And if you look at specific sectors, banks, specialty retailers, and transports all are down around 10% from their highs.
Mm-hmm.
If you look at those, and you're talking about Disney, well, the hyper cyclical media stocks, they're all down around 15% off their highs. And as you were talking about lumber prices going up, despite what we hear about the prices of homes, home builders and home improvement stocks are down around 20% from their peak.
Yeah, I see higher lumber prices rippling through and just making, continuing the trend of more expensive homes, because those home builders, they've got to deliver on their margin targets to get close to at least their EPS targets.
Yep. What are you going to do? Got to pass on those costs.
What am I going to do? Rent. That's probably what I'm going to do. So what else is going on? You're back in Italy. What is going on with that wacky government, and what does it mean for other countries?
So it looks like Italy is likely going to be heading to yet an election again. So Italy, to try and do this quickly, Italy has
another whiteboard moment.
Yeah. Well, Italy is a kind of on the more extreme end of democracy than the U.S. The U.S. is more of a republic, and the U.S. has a lot more kind of stability in the government. If you just look at, used to. Okay.
Do you realize what you just said?
I did. That was pretty funny. The House and Congress in Italy are much, much bigger. There's a lot more people in them than you have in the U.S. And the way they get their version, their prime minister, which is sort of our president, is that person is not elected directly by the people. That's a function of which political parties win or form coalitions to have the majority. So the elections we had on March 4th in Italy didn't result in anyone having a clear enough a majority. None of these little groups, all these different political parties, they couldn't really get band together to form any kind of a majority. So Italy's been without a government since March 4th. And it's getting to where it's like, all right, we're just going to have to run elections again because none of these parties are able to form a majority. Now Italy's one of the biggest economies, the third biggest in Europe, and it having no government, it's putting a strain on things. What we're also seeing, though, over in Europe is this whole story of the synchronized global growth is falling apart. That things like the UK and Italy and France, things are not growing anywhere near as fast.
So is it that, and I just want to make sure that I frame this correctly for the listener, as we wrote in the book Cocktail Investing, there are four horsemen of the global economy, right? Yep. China, Japan, US, and Europe, right? But you're saying inside of Europe, those economies are not moving in tandem anymore.
No, and well, it was supposed to be, though, that China was doing great, the US was doing great, Europe was doing great. Not so much. We just saw industrial production in France just declined 0.4%. That is not in line with the story of this, accelerating economy. We just saw in the UK retail sales fell a record 4.2% on year-over-year basis in April. Again, that is not exactly in line with this accelerating global economy.
Okay, so wrap it up, Lenore. Put a bow on it for me, because if I hear you correctly, we've got 15-20% of earnings to go. Going to be pretty heavy in retail, and I suspect the retail apocalypse will continue. We've got the fallout from Toys R Us, which is going to hit toy companies. We've got other companies that are aligning with Amazon. We've got other companies like Bon-Ton going out of business, so more damage. I think the next week or 2, 3 weeks or so of these rest of these earnings are going to be not as robust as maybe what we've seen before. Maybe some high flyers, but overall, I think more of a downer, if you will. So looking like earnings probably going to be around that 18% mark, right?
Yep.
Anything, so I guess what we'll have to do now is we get ready for May, or we're in May, and then the question becomes, that seasonal slowdown, June, July, and then early July, August. The big push is going to be to assess EPS growth in the back half of the year. Mm-hmm. All right, so it's business as usual.
Well, if we just look what we do know, we know that on the global stage, things aren't accelerating. The growth is not accelerating. Mm-hmm. We've got geopolitical, more increased instability. We've got more questions this year than we had last year. right? That's getting complicated. You've got rising interest rates, which means that your internal costs for companies are going up. You've got where businesses are having a harder and harder time hiring people. So that means internal costs are going up, and businesses aren't able to be as productive as they would like.
Right. And don't forget something we talked about earlier, the unknowns of trade and what that might do. And then remember too, before we're going to turn the corner and we'll be faced with the midterm elections here in the US.
That's going to be fun.
Right. Oh, it'll be awesome in so many wrong ways.
You put that and we are really late cycle. We're really, really late cycle. And one more thing, with all that massive corporate debt out there, right? We've got record high corporate debt. Well, you now have the US running the biggest deficit we've seen out of a recession or a war. So that's more competition for borrowing money, right? Because now the Federal Reserve, the Treasury is going to be borrowing a ton of money as well on top of all that corporate debt that's already out there. So these are all reasons to be a little concerned that going forward is probably not going to be as great.
All I hear you saying is, if I was to think of it as a teeter-totter in the playground, right? It is not even. It is more, the weighted side is skewed more towards risk in the near term. And there's some technical issues that, might also play a factor in that. So we could see this continued bumpy market, this volatile market with wide swings continue as we move through May and probably into June.
Yep. And one of the things to definitely be keeping an eye on is the dollar. Because as that thing strengthens, it causes a lot of pain.
Well, I'm sure we'll be watching that in other things, wouldn't you say?
I
think so. All right. So a lot of ground, but great to recap and be back in the game, as it were, with the podcast. We'll be back next week. Anything in particular you'll be watching over the next couple of weeks, other than the dollar?
I'll be watching what's going on with wage growth. I'll be watching what we're hearing from companies as far as their costs.
I was waiting for you to say, I can't wait for Apple's Worldwide Developer Conference and see what new toys and whiz-bangs Timmy Cook is set to unveil.
God, it'd be great if there's something fun coming out.
There would be. The only reason I call that out is, I like doing it. We should live tweet that this year. That guy, because we tend to kibitz amongst ourselves as it happens. I'm wondering we should live tweet it.
Could be.
I think that's a good idea.
We at least entertain ourselves.
Somebody's got to. All right. Well, that is the podcast for this week. We'll be back next week with more good stuff, more thematic musings, more observations on the market, the economy, all designed to distill all that noise into clear investing signals for you, the listener. Thanks, everybody.
Have a great week.